Welcome to the Energy Desk, a weekly series from Mobius Risk Group analyzing the macro and fundamental trends shaping global energy markets. To take a closer look at any topics discussed on today's episode, head over to our research archive at research.mobiusriskgroup.com. Let's dive in.
Hello, everyone, and welcome to the weekly Mobius podcast. This is Mohit Arora. I was here last week with Alex for the first time, and it was fun. Just to reintroduce myself quickly, I head up the Risk Analytics and Decision Sciences group here at Mobius and have been here for about 7 years. In my role within the strategy team, I help our clients understand where risk sits in their portfolio and what the current market opportunities available to them are. Since Alex is out, I have a very experienced colleague of mine from the strategy team in here with us today, TJ Poole, who's a VP of Natural Gas Commodity Risk. And before we go any further, TJ, can you please introduce yourself and tell us about your career prior to coming to Mobius and what you do for us and our clients?
Hello, everybody. I'm TJ Poole. I've been at Mobius for about 7.5 years, but I'm a pretty long-term industry vet like Mohit. Started way back in the late 90s on the merchant side, primarily focusing on natural gas trading and risk management. Spent some time in the hedge fund world and came over to Mobius, where I headed up the physical desk for quite a while. And more recently, I've moved over to the strategy desk, where I focus on regional price risk, fundamentals regionally, what's going on in the market, how things are shifting, and also longer term physical strategies for our clients. And I also work a lot on midstream strategies and transport as well.
Thanks, TJ, and welcome. Let me kick it off with one of the pieces we had discussed last week, which was speculator positioning. Last week, we talked primarily from an oil perspective, and we talked about positioning in the crude oil markets and the products markets. This week, let's talk about positioning in gas. And we'll also touch upon some of the other topics, such as where the market's headed, basis differentials, and LNG. So starting with positioning. About a month ago, we were highlighting to our clients how gas speculator positioning was quite long and how prices were still pretty elevated. They were over $4. And if you think about seasonality, we were exiting winter. So seasonally, we were going into a weaker period. And the risk was that this length could get caught offside. And we were also approaching some technical supports. And when you take the impact of things like algos and CTAs in the market, the risk was that of a speculator rush for the exits and leading to a quick move lower. Now, if you think about where we are now, fast forward a month, and we are right around $3, and the positioning now is far more balanced. And that is because a lot of this excess spec length, almost 120,000 contracts of length, has come out of the markets in the last 4 to 6 weeks. Again, that highlights how speculator positioning is one of the risk factors in this market, which one cannot really ignore. And from here, TJ, maybe you can give us some perspective on where prices have been, and now that we're at $3, where do you think we're going from here?
Sure. So if we do a little historical look back at this past winter, we went into the winter with fairly healthy storage levels, around 3.9 TCF in the ground. The market was recognizing that there was potential risk if we got a cold winter, but was also in recovery and shock from and just placated by just continuous warm winter after warm winter. So even though there was some risk premium built into the market, I think the market was very much level set on we're just going to have another warm winter. Forecasters were calling for a warm start to the winter, because if you had been calling for cold starts and cold winters, you were no longer working as a weather forecaster. So people were being very conservative on that front. And sure enough, we get into the winter, and November and December are extraordinarily warm. It's the 5th warmest November, December on record. And the market clearly gave up hope, probably late November, early December, on the entire winter. We get into January, the market's very low. Salt storage is extraordinarily high. And lo and behold, we do get some cold weather that comes in. It's a fairly brief shot, something we've seen very frequently in the last few winters, not extended cold, but these brief, intense Arctic blasts. And the market got elevated off of that. Then we get into February and we have a second cold shot, something that was almost unheard of in recent history. And the market really started to get beefed up. And then about in February 10th through the 14th-ish, we got a forecast. The market was calling for another round of Arctic potential hitting late February, early March. And that was when the market said, holy moly, this is the time. And the summer strip rallied extensively. Between early Feb and early March, the summer strip at the time went up $1 from 370 to 470 as the market really got concerned about our end of season storage levels. Back in November, December, early January, before those cold Arctic blasts came in, the market was pretty comfortable with saying that we were going to come out into the season somewhere between 1.8 to 1.9 TCF. Maybe some people were even calling for a higher end of season than that. And if the weather hadn't turned colder, that's for sure where we would have gone. Once we got past that first round of January cold, and now we're sitting on the secondary round in February, and we see a forecast for another potential Arctic blast, the market got really concerned that we could drop down to below 1.5 TCF. And when you're looking at 1.5 TCF, you're looking at, compared to where we came out last winter, it was 750-ish year-on-year deficit. And that's over 3 BCF a day to make up throughout the summer. So producers, everybody got really excited. Prices went well above $4. And to Mohit's point, once we reached above $4 is when we started to become concerned due to not just speculator length in the market, but a lot of the numbers that we saw in the weekly storage numbers were becoming very loose. So we started to advise our clients that this is the good time to hedge the summer strip through 26 because things are starting to look really loose. Now, there are two major factors that kind of really got the market concerned and everybody kind of piling on the same direction with the sell-off that ensued. One is that third Arctic blast did not materialize, and March actually ended up being the third warmest March on record. Salt storage turned around in an impressive feat and went from a 2-month stretch of the largest salt withdrawals that the market had seen to a month and a half, 2-month stretch of some of the largest builds in salts that the market had ever seen. Once we got above $4, the amount of switching from gas to coal was more than what people anticipated. So gas went from 75% of the thermal stack to close to 65%. So a lot of factors started weighing on the market and accelerating this sell-off in the near term, the prompt, and even throughout the curve. Once Trump announced his tariff plan, and then there was confusion and a little bit, I guess you would call it chaos surrounding that, and broader market started to sell off. Natural gas got caught up in that as well. Now, there's no direct reason to sell near-term natural gas due to any tariff-related potential items, but it got caught up in that macro sell-off. So here we are with May trading sub $3. The balance of the summer is around $3.30. And where do we go from here? Clearly, as Mohit just mentioned, the speculators are largely sitting on the sidelines at this point. Producers, end users, nobody really knows what to do. $3 seems pretty cheap compared to where we were just a month and a half ago. But historically speaking, $3 to $3.50 for the summer strip, NYMEX, is still a hefty price. I think it's around the 80th percentile, if I recall.
Correct. Yep.
So I think there's a lot of uncertainty, and rightfully, we still have a lot of production. It's a very noisy time of year. Typically, a podcast or a discussion or a client meeting in the April timeframe in natural gas, there's not a lot of exciting things to talk about. The winter's kind of over. There's no summer weather forecast out. You're not starting to get a cooling demand just yet. There's a lot of maintenance that goes on in this time of the year, so there's a lot of noise in pipelines. So it's hard to tell what production really is and how much is being whipsawed around due to production or due to maintenance on various pipelines. But there is a lot to talk about and a lot of excitement there that's going on this season. And we think that'll continue for the next few months. Directionally, I do think that we are closer to a bottom. One of the factors, like I said, is once we got over $4, we saw a lot of gas to coal switching. And now that we're getting down to $3 level, we're seeing a switch back. People do want to hold on to their coal reserves a little bit and hold off to maybe use them later in the summer when we do get a lot of cooling demand. And we are seeing that thermal load pick back up. But we're still in this point where renewables are heavy on the market right now. That's the solar capacity is up 30% year on year. You get into early summer, the days are longer. You start to see the effects of that. Wind is also more prevalent in the shoulder seasons. As you get out of winter before the heat gets here, this is the windiest time of the year, historically speaking. And so that weighs on overall power demand for gas and coal. Production's remaining pretty resilient. And that's something that's weighing on the market. I think people did anticipate that once we got down lower, that production would start to fade a little bit. And it may. A lot of the decisions that were made to maintain activity back when prices were $4, that's still in effect. So there is a lag effect. We may see that production start to suffer as fast forward a month or two. And so there's a lot of different factors to consider. I would say if you were to look at a ledger of bullish points versus bearish points, the bearish points are definitely larger and more numerous than the bullish points. But that's why we're down here at $3 instead of still over $4.
Yeah, to your point, in terms of the rally where the summer of 25 went up to well over $4, you've seen that weakness come into the market now, and where you had that backwardation now, summer 25, summer 26 has gone from whatever, plus 50, 60 cents to about minus 50, 60 cents. But the backs are still pretty rich if you look at the curve. Do you think there's some opportunities in the back for producers or consumers to consider here?
I do. I think there's still a lot of producers said for a long time, survive to 25. And now we're in 25 and it looked very promising for a little bit. And now there's a lot more concern, not just on the gas side, crude oil lingering around $60. That's a big concern factor for your producer. And that's a big concern for associated gas. It's more of a longer term effect on associated gas. But that's a concern. But you still see this, I can't think of a good rhyme, but live to 26 or something like that. Because Cal 26 is still pretty elevated.
Right.
So what are people
27 is still like 30, 40 cents backward, right?
And so what are people looking at as what's going to change? What's going to make Cal 26 be so much better than what we're looking at now? LNG is obviously the big story that has been driving the market and will continue to drive the market year on year. This coming winter, let's just look at it that way. This coming winter, there's going to be about 4.5 BCF of incremental LNG supply than there was last winter. That's thanks to Plaquemines and Eastern Louisiana coming online. It's going to continue to grow as phase 2 starts up around the middle of this year. And Corpus 3 is coming online, an expansion of the Corpus facility. That's going to continue to grow throughout this year. And at some point at the end of 2025, early 26, we're also going to get Golden Pass, which is right in that southeast Texas area, very near Sabine Pass. Still a little uncertainty of exactly when that will come on, but by Q1, you should start seeing that facility exporting. So if you look at Cal 26 overall, you're looking at about, again, it's very heavily front loaded, but about 3.5 BCF of incremental LNG growth. Now, production is supposed to pick up. People are anticipating that we'll see production continue to grow and more make up for that LNG growth. And we are seeing that today. LNG growth this summer is expected, summer 25 is expected to be up 3.5 BCF from where it was last year. And a lot can change, but if you look at where the past month has been, production's been about 4.5 to 5 BCF up every year. So I do think that 26 with the lower prices, the concern is, or if you're a bull player, what's keeping you happy is there is going to be incremental LNG growth, and production is at best questionable right now, because to get the production to where we need it to manage that LNG growth and just general power growth that we're expected to see, especially in the Southeast, you do need a lot of production growth. And to get production growth from this level, you need activity, you need capital expenditure. And we're not hearing a lot of people willing to spend capital to grow production. They're willing to spend capital to maintain production, but which is especially expensive in areas like the Haynesville. But as far as growing production, we're not really seeing the activity in rig count. We're not really seeing the activity in frac crews. And there's only so long that people can grow through DUCs and delayed tills.
Yeah, and to your point, the longer we stay down here on crude, you can't count on that associated gas. That was just a freebie. Everyone's happy with it at 75, 80 bucks. It's okay, cool, that gas is coming out. I really don't care. But now with crude sitting in the 60, 65 range, you're not going to get that growth, at least from there. And that becomes another concern in terms of where's that production going to come from?
Exactly. And then, we talk to a lot of producers and we read all the reports, and it turns out there's quite a big difference between a $60 forward curve and even a $65 to $70 forward curve. If things go up into the upper 60s again, then probably we'll continue along the path of expected production growth in the oil market and so associated growth, especially in the Permian. But for the gassier areas, Haynesville, we need growth there. And it's the Haynesville producers have said they're not going to do it if prices aren't extraordinarily high, $4.50 to $5. And we're seeing that it's not really happening. Now, of course, every producer does turn around and say that I may produce at a lower level, but I have this tier one, this great production, but all these other producers, they're going to need $4.50, $5. But still, it still has been a focus on everything that we're hearing from producers is capital discipline over growth, expansion through acquisition, not expansion to the drill bit right now.
And we're also seeing some sort of hesitation in M&A activity because towards last year, I think last year was one of the highest M&A activity years in recent times. And I think with the tariffs, with prices coming off quite a bit, I think a lot of those deals are out there, but just like the housing market, the bids and the offers are very far apart. So is that something you're also seeing? And
Yeah,
can you talk about it?
Last year, definitely a lot of the low-hanging fruit was picked. So this year, it's a little more difficult to find assets that are compelling to potential buyers, and people are looking further out away from the Permian. I think the Permian is consolidated to a point where it's going to be level set for a little bit. There's been a little bit of activity in the Marcellus. EQT picked up a new property, and then we may see focus return to more of the Rockies area as far as a little bit of M&A activity this year. But I agree with you overall. It's going to be a much different year, especially in the second half.
Mm-hmm. And given that LNG is one of the big drivers, what impact is that having on the basis markets? Because again, looking from a statistical perspective, there were many basis markets which were okay a few months ago, but right now, except for the Southeast, pretty much everything is at very deep discount on the basis spreads if you look at them. Can you talk about that a little bit?
Yeah, so it used to be that all the basis activity and excitement that everybody wanted to talk about was Northeast and California, and those points are definitely still exciting. But we have a mini along the Texas, Louisiana, Southeast stretch that has become a very exciting area where a lot of basis that traditionally hasn't been very volatile has become extraordinarily volatile. If you look at what Ship Channel's done over the past year, and even recently, what Columbia Gulf has done in West Louisiana and into the Southeast, and of course, we haven't even touched on Waha, which has seen basis moves that have been larger than even the volatility in absolute terms, and even the volatility we're seeing in the NYMEX. And there's a lot of reason for it too. Obviously, the LNG growth story that we've seen in Texas and Louisiana has demanded gas find its way there. People are also looking at what's the next phase. If the Haynesville can't supply everything that has to happen or at least the Louisiana Haynesville can't supply what has to happen in the Louisiana coast, then it's going to have to come from Texas, either from the Texas side of the Haynesville equation, or we have to expand and bring more Marcellus gas down, which was questioned if that was possible, with people seeing what happened when MVP tried to bring more Marcellus gas to the Southeast, and it just became a lawsuit train wreck and cost way more money than anticipated and took years longer than anticipated. There is some signs that we may see potential for more Marcellus gas to head south. Texas Gas, which is owned by Boardwalk, did announce an expansion, which is a much safer bet than MVP, which was a greenfield new build, whereas Texas Gas can expand along their existing footprint and bring more gas from the Marcellus down to the Southeast, down into Louisiana to help fill that gap that may be lacking from the Haynesville. While the Haynesville producer is sitting there going, I need $4.55, the Marcellus guys are up there going, I could do it for $3. So please just let me get my gas down there. On the other side of the equation, you have Permian, which continues to grow and obviously may have a hiccup here depending on what happens with oil prices. It grew out of its clothes and it became too big for its footprint. And that's why we saw negative pricing a lot of last year, a lot of last summer. And we told our clients, I was like, when we went into the winter and Waha prices became strong again. I say strong in quotation, very strong for Waha, but still lagging everything else in the country. We caution people to be really concerned about March and April Waha basis, because once we get back into that shoulder season, and even with Matterhorn, which is the new pipe that came online to take additional gas out of the Permian, there's going to be maintenance. And when you have the combination of the demand starting to drop in Texas as you go into March, really, before the heat gets here, and just maintenance events on those pipelines, we're at risk of negative pricing. Sure enough, we got into March, cash was negative at Waha. The first of the month, April index was close to minus $1 fixed price for Waha. So that's when the market got really concerned again. There was additional maintenance that was planned for April in Waha. And I've shifted over to the Waha story a little bit here. And the market, rightfully so at the time, decided fixed price at Waha for May needs to be negative. It needs to at least be zero. And so the basis widened out as the NYMEX was rallying because of the cold we saw in February and the risk of additional cold. Waha basis had to expand because Waha fixed price actually had to go down for May. So we saw the May Waha basis widen out to $4.25. We get in April and we're not seeing these Waha prices crash down to negative levels. You could just always leave it to Waha to really mess with people. It's always going to be it's a tough one to call. It just seems like things happen there. It's a lot of interstate, so you don't have a lot of visibility. So it's always a wild card. And so about the time that the market decided that the NYMEX was way too high at 425, 450-ish, it also decided Waha fixed price for May was way too low. And then you get the volatility in the basis because the NYMEX is falling and the fixed price at Waha needs to go up. So we saw that basis tighten in as the NYMEX fell $1.50. That basis tied in $2.50. So lots of excitement out there. That's good for the producer, but we're still going to be in this time of uncertainty about Waha prices. When you get into the summer, you'll have enough local demand and you'll have enough. The maintenance season will mostly be over to where we should sustain positive prices throughout the summer. But this coming shoulder season, Waha producers need to be on the defensive again about gas, and next spring as well. Because even though there is a lot of build out from the Waha that's occurred over the past few years, and there is a lot of build out of the Permian that is slated to continue later in the decade, between now and mid-26, there's a drought. Matterhorn's on, and it's running near full capacity. But once we get past that, the next expansions don't begin until mid-26. And we have Gulf Coast Express has an expansion on their existing system. And Blackcomb, which is a Fargo and Whitewater, that's the next big new pipe that comes on out of the Permian. And that's not going to be till late 2026. And then you have Hugh Brinson, which is a pipeline by Energy Transfer that takes gas from the Permian to more of the Northeast Texas market to Maypearl. So a little bit different story on even where the gas is going to go compared to a lot of some of these expansions that have come on the past few years, taking it more to the Katy area.
Yeah, one of the things which you mentioned was how the Waha differential gets very negative and then bounces back. You seeing any opportunities out in the forwards? Because one of the things I've noticed is there are times when the basis might be really wide, but the all-in pricing might be still attractive for a producer to hedge. And so are you seeing any opportunities further out where producers could step in and do something where historically those are good prices where they might be able to say, you know what, I can live with that price, rather than waiting for that volatility to come and hit them inside of 12 months?
Certainly. And if you look at Cal 26, Waha pricing is close to $2 fixed price, maybe just slightly shy of that. And once you get past that, 27 through 28 is 250 and above. Now there are a lot of solutions, as we mentioned before, coming in that late 26 period and through 27 and 28. But I think for the rest of this year and for Cal 26, that this is a time to protect your Waha fixed price if you could do so at $1.50 to $2 range. I think that's a point, again, where for producers who mainly have to play defense and just can't be flaring gas or shut in their oil production. I think that if you can get above $1.50 and close to $2 on your fixed price, that should be a very happy area for people.
Particularly given where we've been in the past many years. I mean,
we've had not only negative first
we've
month.
Had negative all-in pricing, yeah.
Yeah, we've spent a lot of time over the past 6 months outside of January and February and December in the negative area with gas daily pricing getting negative $5 at times.
Let's circle back to one other topic we talked about, which is LNG. What do you think are the impacts of all the tariffs and all the other uncertainty, production? What's that going to do in terms of LNG going to Europe potentially and the storage there? Because if I recall, the storage there is still pretty low and it's not filling up fast enough from
Correct.
what I could see.
Yeah, so I guess there's a lot of stages of how you could discuss it because there's a lot of moving parts in LNG. LNG, we like to focus on Cal 25 and Cal 26 or what's happening in cash tomorrow, but the LNG story is a multi-decade type story that we need to really focus on and try to wrap your arms around. I guess going back to the main thing that's held up, that's been a concern for LNG producers and people wanting to get projects to FID over the past few years has been the previous administration's slowing down the permitting process and not allowing permits for exports to countries that we don't have trade agreements with, which is all the countries that we want to sell LNG to. The new administration came in and we've had just a fast track to permitting. So that was a very positive sign for facilities that were waiting around, especially some of the facilities that were really on the chopping block whether or not they were going to happen, which is now Woodside, or I think they even may call it Louisiana LNG now. But that's back on the table. Commonwealth is back on the table. Calcasieu Pass 2 is another potential one. And these are all facilities that even if everything went forward at a healthy pace, first flows would be Cal 29, Cal 30. But now they also have concerns about whether their costs going to be. Are they going to be able to import the things that they need to build out these facilities? And it's not just steel. There's a lot of components of the LNG facilities that they need. They were already struggling from an EPC standpoint because there aren't that many companies out there. There's not many people you call to say, hey, I want to build an LNG facility, an LNG plant, and they get stretched a little thin. But especially after Zachary declared bankruptcy while working on the Freeport project. So there was a thinning out of the capability or the people that you would call to build these facilities. Now the big concern is I don't think there's as big of a concern as people like to think over tariff or tariff war inhibiting our ability to export to China. We only export a small amount of LNG to China. And in fact, over the past 60 to 90 days, we have hardly exported any LNG cargoes directly to China. So when China drops off, China would rather depend on multiple sources for their LNG or their natural gas needs. They're also building up internally production. Their internal production is providing more and more or satisfying more and more of their gas needs. And coal prices are depressed worldwide. And China is more than happy to drive their growing power needs based on coal because it is a security concern for them. They don't want to rely on Russia. They don't want to rely on the United States. They want to be independent. And coal is the only way they could get there, or at least get there a lot of the way. But most of our gas future, as far as LNG exports, are going to be to Europe, to India, to the South Americas, and Japan and other Asian countries. We don't necessarily need China. So we can go forward with these facilities as they are. I don't think it's going to really hinder anything from a concern standpoint. There is a small little tidbit that was thrown out by the administration. I'm going to guess it gets quickly retracted or at least revised, where they wanted LNG tankers that export out of the United States to be growingly United States built LNG tankers, United States flagged and United States operated LNG tankers, which the problem with that is that we have no facilities in the United States to build LNG ships. And to facilitate that would cost billions of dollars and decades, to be honest.
Take a decade, yeah.
So that's nothing we're not going to start building LNG tankers in Galveston anytime soon. So I'm going to guess if that gets changed. There's one LNG tanker that it was built in the United States, it's flagged and operated by American citizens, and that is a tanker that goes back and forth between the United States and Puerto Rico.
Yeah, I suspect that will change. But that is really interesting. That is all I had. And thanks so much for joining us, TJ. And thanks to all our listeners. Hope you enjoyed and will join us again next week.
All right. Thanks, Mohit. Thanks, everybody.
Thanks for joining us at the Energy Desk. Again, this is a limited series, so if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.